but banks are offering less and less for depositors. Some in Europe even negative equity.
Mm-hmm.
You can even get negative interest mortgages and stuff, which theoretically makes gold much more appealing to many savers.
Yeah.
Just talk a bit about that and what you think on that point.
So that's precisely the case, that negative real interest rates are very good for gold. So if you see negative real interest rates turning to positive real interest rates, and that is less positive for gold, and I think that is by and large what market orthodoxy is, particularly in the United States at the moment. But I don't think, with government debt at 100% of GDP in most of the Western world, and quite a lot of the banks still heavily exposed to the mortgage market, you think, well, what does rising interest rates do to their underlying asset base? Well, it's not good for house prices, it's not good for businesses. So if it turns those assets sour, again, you have the same problem. The banks going into, well, effectively going bankrupt like they did in 2007 with your Northern Rocks and your Lehman Brothers and your Bear Stearns. So that's part of the reason why I think there's not much scope for that. Now, should the market revert to that sort of appreciation and that sort of analysis and say, actually, there's not much scope for interest rates to go up, all right, inflation is wherever inflation is, but we might just have to leave it there, then that is a much more encouraging environment for gold. In fact, I can't actually remember in my life as a financial analyst or my life of watching financial markets a more difficult time to try and predict what the future holds. And I remember if I went back 20 or 30 years, there were certain themes that you could play. For example, you might have played at the time that small cap always outperformed big cap, that Southeast Asia always outperformed the developed markets. And that was true not for days or weeks or even months, but it was true for months and years, and possibly at a stretch it might have even been true for a decade. And you could play those sort of big themes for a long time. But now that doesn't seem to be true, and market sentiment can change very, very rapidly. At the moment, I think, as I say, market sentiment is orthodox. This is an orthodox recovery from an orthodox recession, but I think that can change very, very quickly. And if it does, I think you could say, I think that probably the transition from negative real interest rates to positive real interest rates is worth something like $250 per ounce on the price of gold. So a sudden appreciation, which could come from a comment from Janet Yellen, for example, or the President of the US, or the People's Bank of China. I mean, any number of things could catalyze it, or any number of extraordinary geopolitical events could change the outlook on interest rates. And if it did, I would have thought that gold would put on $250 quite quickly.
Edison's forecasting a gold price of $1,537 in 2020, rising to $1,899 in the event that negative real interest rates prevail over the same time frame. Can you just talk a bit about why you've come to those figures?
Those figures were derived from two separate analyses, and one was relating the gold price to inflation, and one was relating gold price to the money supply. And what we found from that is that gold is expensive relative to inflation, cheap relative to the money supply. And then quite simply, to get that figure, what we did is we looked at the top and the bottom of the range and we divided by 2. So that is halfway between the top and the bottom of the range. And so if you like, if the gold price is below that level, you can see the risks, or the opportunities, as I prefer to call them, are skewed to the upside. If the gold price were above that level, then you'd see that they were skewed. The risks then, and they would be genuine risks, would be skewed to the downside. So where we came to the conclusion about prices with positive real interest rates was we took out one of the scenarios that related to negative, that we took out the single scenario that specifically related to negative real interest rates. And then that brought the whole range of prices downwards by about $250 an ounce.